This is Market Pulse by Faster Forward from Northern Trust Asset Servicing. My name is Marc Mallett. I'm the Chief Strategy Officer for Northern Trust, and I'm joined today by Gary Paulin, I'll take a moment because Gary's really thinks his title is very important. Head of International Enterprise Client Solutions at Northern Trust. There's a lot in that, Gary. Yeah. So I'm very interested to hear where you're spending your time. So today we're going to be talking about some investment themes that Gary's been focused on. It's great to have you back. Always exciting to have you on the podcast, and really looking forward to today's conversation.
Great to be here.
What I thought we'd start off with was just hearing, what's top of mind. You've been writing about a lot of different things over the last few months since you've last been on the podcast. Anything in particular in the market that's top of mind?
So what's top of mind is isn't the market so much as more the Olympics in France. There's a French philosopher, guy called Albert Camus, who said the best way to understand the world is to sometimes turn away from it. So I've turned away from markets and I've focused heavily on the Olympics of late, which I'm just enthralled by. I'm now madly in love with Celine Dion. She is just somehow recaptured my attention, which I thought what she did was incredible. And also there's a couple of other characters that really stand out, one of which was an Australian hockey player who broke his finger 2 weeks before getting on the plane to go to the Olympics, to be told by a surgeon that if he operates, which he should, he won't be able to play. So you know what he did? Chopped his finger off. Now that's commitment. I'm not sure you'd shown that sort of commitment to Northern Trust.
This is field hockey.
This is field hockey. Okay. That is, tough times don't last, but tough blokes do. That was very impressive. But back to markets. I think sport always has some relevance to markets, and the Olympics notwithstanding. And I think what the Olympics does always remind you of is, the importance of shared experiences. It shows how, it unites, it brings people together. It also reminds us that team spirit is found at the bottom of a pint glass, which was certainly where I found it last night. And it also, I think, reminds you of the importance of national identity. And this is the segue back to markets. I think this idea of national identity transcends not just sport, but also politics and potentially even asset allocations. And one of the things you see, everyone over here, the big sport is the elections, and everyone's trying to predict who's going to win that. I'm trying to think what will endure beyond that. Thinking through to next year when we move from campaigning to governing, and are there any characteristics today that will continue then? And I think one of the underlying themes is this idea of nationalism. And the reason I say that is I think, if you want to find an amazing technology, you could point to AI, but I think perhaps the most profound technology we've had over the last 30 or 40 years has been horizontal drilling and fracking. Why? Because the US is now self-sufficient in energy. So back when the US was heavily involved in external affairs, be it in the Middle East, Russia, wherever, they were heavily dependent on external forms of energy importation. That's no longer the case. And I think that's hugely impactful. And it just means that they no longer need to be so mindful, and they're starting to focus a little bit more internally. And that has, I think, quite profound implications. We call it a tectonic shift. And I think that's a really apt metaphor, because if you think of, back when we were Pangaea, we were one continent, then it split. It split into two, and then it fragmented more. And I think that idea of fragmentation is starting to percolate more and more into how we think about asset allocation. If the world is no longer flat and the world is fragmented, then I think you might start to see allocators start fragmenting their allocation. And if you are really excited about the UK, like I am, or Japan or other parts of the world, and you want to get exposure to those interesting opportunities, well, you're not going to find those exposures in the ACWI world, because there you will just find the US and probably 4 or 5 stocks within that.
So, you talked about some of the countries that they're interested in, UK, Japan. What about those areas is makes them interesting? So
let's start with the premise that I think where alpha could be sought best going forward with an equity standpoint is by moving away from the index and thinking more regionally. Not just because politically we're thinking more regionally. I think there are interesting things going on in certain markets. Now, as you know, I've been writing about Japan for some time, and I still think that bull market is young. I think it's a young bull worth riding, and once we get through this carry trade unwind, I think there is an opportunity there. There's still good value in Japanese stocks. I recently looked at some screens, and about 50% of the TOPIX still trades below book value, and about 20% trade below 0.6 times book, which means they need to double to get to 1 times book, which is the target of the Tokyo Stock Exchange. You've got incredible amounts of cash being generated, you've got record buybacks, and you've got 4 times the amount of cash on the balance sheet of what you have in the US. So I think Japan is still at an early stage. You don't fix the 3 decades of behaviour in 12 to 18 months. So I think that's still very interesting. I think China's really interesting. Obviously, there's lots of risks, but I think those risks are starting to be discounted in price. You've also got reforms, and these reforms are very much aimed at domestic consumption. Now, forgive me for being rather simple about this, but you can't fix consumption unless you fix confidence. And the easiest way to fix confidence is by increasing collateral values, right? Wealth effects. And what are the 2 biggest forms of collateral value in China? One's property and the other's stock market. So I think property and stock markets become policy levers, and I think they will be pulled. And I feel reasonably comfortable playing alongside that lever being pulled. The UK is still perhaps the one I'm most interested in, and there's a little bit of a bias because that's where I'm situated. But we've also got catalysts now, and the catalysts come in a range of forms. We've got incentives. So the government stopped beating up on bankers, by the way. So sentiment-wise, that's quite a big thing because the bankers were part of the problem. Now they're part of the solution, which is interesting. We've got stable government, which is governing from the centre, right, as the rest of the world's trying to tear itself apart. That's unique, that's interesting. That feeds into risk premia. And risk premia in the UK is still extremely high relative to other parts of the world, particularly here in the US. It's almost double. We've got catalysts in the form of incentives to create more of an equity culture and getting retail investors back into the market who basically have fled alongside with Brexit and have invested everywhere else but their home market. We've got tax incentives that might bring them back. That's important. We've got reforms around MiFID, so more research provision. We've eased our listing rules to make capital more attractive to being listed in the UK. But far and away the most important is pension reform. Now you hear a lot about pension reform in the UK, but it matters because pensions are such an enormous part of the available capital that can be put to work. And it wasn't that long ago, late 90s, where UK pension assets had about half of their available assets invested in UK stocks. Fast forward to today, that number's about 2. In fact, the government's own pension fund has 1.7% of their assets in UK stocks. Now, that is about to change for 2 reasons. One is we're a predominantly defined benefit system, but that's now changing. They're all in surplus, or a lot of the corporate funds are in surplus. That means the corporates no longer have to keep filling the pension pot. They can use that money for other things like buybacks or capex, something rather new and exciting.
Was that driven by in the interest rate environment? Did that help create that?
100%, because their liabilities are discounted to the So as the discount factor interest rates went up, their liabilities went down. So that's certainly been an impact, but that's relevant. And now they're being sold on, those liabilities, to insurance companies. But we're now seeing a move towards more defined contribution. Now, for the first time ever in May, defined contribution inflows out were bigger than defined benefit inflows. That hasn't happened for a very long time. So I think the forced selling stopped, and now we're about to see more money flow into defined contribution. Defined contribution typically invest in more growth assets, whereas defined benefit need to match their assets and their liabilities. So one's more risk averse, the other's more. The 2 countries in the world that have the most defined contribution are Australia and the US, what do they also share? The two best performing share markets over the past 120 years. Right.
So a bit of supply side of sort of the push of funds into the market.
Exactly. Exactly. So I'll give you some numbers. So about $1 trillion has come out of UK equity markets from that pension pool, and I mean the market's only just over $2 trillion. So it's an enormous. Now, in 2 or 3 years' time, the government's going to force pension funds in the UK to disclose their holdings. Now, in a world of national identity, I think it's going to be incredibly hard to justify an underweight position. And I think you'll find that others and some might go way beyond that, especially if markets are going up, which I think they will. So I believe we have a pension put emerging. Right, we've got a Fed put. I think we've got a pension put in the UK that's starting to emerge. And if I was an allocator, I'd be seriously considering finding alpha regionally and reallocating towards the UK, which I think is still one of the more interesting opportunities. The other market I'm really interested in is Finland.
Okay.
Because I think the other mispriced outcome, something we're not talking about so much, well, we talk about it, I don't think we think through it, is I think we're mispricing the probability of peace in Ukraine. Now, I'm not saying that's going to happen, I'm just saying that the market's mispricing that outcome. And if you were to get it, then one of the countries most likely to benefit, who shares the largest border with Russia, is Finland. And there's another reason why I think Finland's really interesting, we'll perhaps come on to in later questions. But so anyway, so being a bit Finland aside, I think the UK is a very interesting opportunity. Japan, I think, still, if you look back at Japan, only very recently broke above its 1989 peak. If you go back to when the Dow broke up above its 29 peak, it compounded 11% for the next 10 years.
Yep.
Could history rhyme? Yeah, I think it might.
Yeah, I suppose if taking a different view from regional, but if we look at sort of a very sort of thematic things going on that you find interesting.
So I think last time I was on, we were talking about GLP-1 drugs and the impact that's having for obesity rates, but also some of the implications there. I think we're starting to think now about the second order effects, and now we've had more time to experiment with these drugs. Some doctors are microdosing. Some of the data that's coming back is just extraordinary. So when we mentioned, the impact of on not just fixing things like diabetes, but also heart disease. Yep. And if you're thinking productivity, we all point to AI as the great hope for productivity. Well, just think about a recent paper written by the Tony Blair Institute, the think tank in the UK, and they were looking at heart disease of workers over 50. About 20% of workers over 50 will leave work before retirement because of heart issues. And if you were able to fix 1/5 of that cohort, then you're increasing worker productivity by £2 to £3 billion per annum. So there's huge amounts of hope for these drugs, not just in terms of the health benefits, but also the economic ones. So when I say second order effects, I'm starting to think through more about the economic benefits. The other really fascinating aspect of these drugs is they seem to be impacting the reward networks of the brain. So they're impacting people's addiction to eating, obviously, to smoking, drinking, gambling, and I'm starting to question whether it might also start to impact our addictions to, because it's the same reward network, it's dopamine, social media. Now, this is the book I've been reading, which if anyone's got young children, prepubescent, preteen children, I think it's almost essential reading, is called The Anxious Generation by Jonathan Haidt. And I think this is going to be one of those touchstone books that, changes behavior, certainly of our parents. And basically what he's done is there's always been this assumed correlation between social media and teen depression. Well, he's now attempted to prove it using evidence. And so he looks at Gen Z, so those children born after 1995, and they are the first cohort to go through puberty with a portal in their pocket. Yep. And they've moved from this sort of real world play to to phone time. So they've moved from, I can't remember what his term is, but they're spending all of their free time now on phones, and this coincided with this movement to really overprotect our children in the real world and almost let them free on the online world, without protection. And he's saying it's rewired children, and especially those at that age, because the prefrontal cortex isn't fully developed, and that's the part of the brain that's your sort of your second order, your thinking part, that delayed gratification, your control of temptation, all those sorts of things, is not fully developed, and therefore it's incredibly vulnerable to these influences. And so that's, I think, of real interest. And bringing it back to markets, he's suggesting we need to age-gate iPhone and social media. Now, we're starting to see this being adopted. Yeah. California's just announced it. New Zealand's just, I think, banned iPhones for lots of schools, and my kids' school in the UK, they're doing the same. Now, back to Finland. Instead of us allowing to give them an iPhone, they're actually giving us a brick phone so that we can stay in touch with them and SMS. Do you know what the phone is? It's a Nokia.
I was going to say, the old Nokia flip phone.
The Nokia. And Nokia once had 70% market share of the Finnish stock market. You think Nvidia's got concentration risk? Go and have a look at Nokia in 2000. Yeah. So it could be the antidote to this, this counter movement towards social media. It could be a way of, it could be picked up as a way to help our kids, and of course you might get a peace dividend, and Finland, could be one of those beneficiaries. So those sorts of things have been top of mind. The other sort of thematics, which I'm still very interested in, space. I think we mentioned when we were here last, space is fascinating. There's so much stuff going on in space. In fact, part of the military issues currently in space. Yeah. We just don't see it. Why? Because there's no reporters up there. There's no photo ops. But there is a huge economy already in space. Yes, military is a big part of it, but also communications, Wi-Fi, Starlink, these sorts of things. Space solar is possibly one of the answers to non-intermittent baseload power that doesn't leave a nasty side effect like nuclear does. So that's interesting. Apparently the US military are already using it, i.e. those folks that brought us things like GPS, the microwave, the internet, radar, may soon bring us solar. So I think that's interesting. And keep an eye next year, just linking back to this idea of nationalism, I think we might actually see that fragment into sub-nationalism, provincialism. Go and have a look what's happening in Texas. Texas are talking about setting up their own stock exchange. I can't help but think there could be a certain person behind that, a certain Elon Musk, right, who would love to IPO SpaceX and launch it from, Texas. I'm just speculating, but this is my reading of the tea leaves. And if you think of SpaceX, I think SpaceX could be an extraordinary opportunity because, like what NVIDIA is to GPUs in terms of market share, they are to low-orbit satellites. I think they account for about 70% of low-orbit satellites, and their speed and efficiency advantage is miles ahead of anyone else. It's more than China, more than NASA put together. So,
and they're still the only ones with repeatable rockets.
Exactly. Yeah. They get back to it. So watch this space. Yeah. Sorry. So that's of interest. And there's another thing that comes from space. Did you know?
I'm waiting to be enlightened.
Gold.
Okay.
Gold comes from outer space. True story.
So we're mining gold in outer space.
No, right. Gold, that's how it was formed, from some cosmic collision. Look it up.
All right.
Gold's another space play. I'm still very bullish on gold, not just because it is one of the ways that enables central banks to provide a safer reserve asset in a world that's fragmenting, right? Yep. See above. And that's why we're seeing the biggest demand is still the central banks that perhaps fall outside of the US sphere, the Washington consensus, for obvious reasons. Gold could also play a role in fixing the debt problem, right? You have to bear with me here, but in the US, I understand that the Treasury has a large gold holding, but it's valued at $42 an ounce. And they could, if they wanted to, in some form of debt jubilee, actually utilise the Fed operating handbook and revalue it to current levels or above. In so doing, releasing liquidity to the market without increasing their debt issuance. So that could have a role to play in that, but that's not a reason to own it. Just interesting. But of course, the third thing is this idea of digital gold. Everyone gets excited about Bitcoin being, a good form of it, but it's an imposter to the real thing. And I urge anyone here to listen to the interview we did with David Tate, who's the CEO of the World Gold Council, whose ambition is to create a ledger of all responsibly sourced gold, right? Bring governance to gold mining, put it on a distributed ledger, and then tokenize it and create a digital version of gold, which is backed by the real stuff, okay? Which for people of my generation, we like real things as opposed to, and this could help bring that generation into the digital world and bridge that gap.
So is that increasing liquidity? Is that what does he think what's on the other side of that? What's the benefit of that?
Well, the benefits of the ledger are that you get provenance. So if you're a central bank and you want to ensure that you're buying from a reputable source, well, it's registered. You've got that ledger, and what that means is you remove a lot of bad actors from, in Africa, for example, some of the biggest buyers of artisanal gold, for example, are these mafia organizations. And quite often you might find that money ends up in the hands of rogue states, Russia. And so I think that will help minimize that, which is really important. But then if you can imbue the characteristics of Bitcoin, i.e. transferability, portability, divisibility, with a physical component, well, you're bringing the best of gold's past with the digital future and actually creating something that could also become a currency. So watch this space. But I think that is extraordinarily interesting. And I do urge anyone to listen to David's story, because it's not just about what he's doing with the World Gold Council. It's his backstory, which is, he's climbed Everest 5 times. He does it because he gives a lot of money to a charity in the UK, which is all about protecting children from abuse. And it's an incredible story, and I urge you to listen to it.
So we sort of pivoted a little bit to asset classes, I suppose, but are there any other asset classes that you think our viewers should be thinking about?
A lot of allocators are sort of thinking forward and questioning, right, what are the big risks and what I need to think about in terms of assets to hedge those risks. Fear of inflation hasn't gone away. Right. In fact, we're about to reliquify the system, and I think inflation, like it did in the 70s, could be an issue we deal with again in years to come. And how do you fix inflation? Well, from an allocator's point of view, what are the types of assets that should do well in an inflationary environment? Well, hard assets are one, and I think we're all underinvested in hard assets: gold, infrastructure, agriculture. Those sorts of things are interesting. A lot more conversations around them. Inflation is another way to fix the debt problem. And again, hard assets play to that. But the other asset class I'm starting to see people start to think about again is innovation as an asset class. Right? How do you get exposure to innovation? Right? If you're not Sequoia, if you're not a large Canadian pension fund, and you can't go direct to Sequoia, how else can you actually get exposure to that asset class that is innovation? And there's been some interesting developments in that space, which I've spent some time with recently. The counter to that, though, is for the first time I've noticed a few questioning the role private equity plays within their portfolio, because I think there's a growing understanding that it's not immune to the cycle. Like, all asset classes have a life cycle, and it's clearly showing those characteristics of where it is in its cycle, which is quite late. But more perhaps relevant is its role as a diversifier. So is it a risk diversifier? Well, unsure. The key's in the name, equity. And the bigger issue that folks are starting to raise now is its role as a return diversifier. One of the inherent attributes was this ability to smooth returns. But now as you enter more retail investors and you become or get closer to the regulator demands more transparency and more frequency of valuation, right? And the more you measure something, the greater its volatility. Volatility is a function of measurement, right? So if an elephant and a mouse agree to meet 300 miles down the coast, they'll end up at different pubs. Yep. True story. The reason is because they use a different measure. And it's the same thing. It's fractal geometry, apparently. They tell me. Mm-hmm. And so I think be careful what you wish for. So the more measurement, more volatility, higher risk, less risk-adjusted returns.
So it would then just start to align more with public equities. So you wouldn't get the diversification that you
Yeah. And now I'm fascinated by what BlackRock have just done with Preqin, and they're talking about indexation. Right, that's a very late cycle thing. Could that sort of squeeze out even more of the alpha element, which is interesting to watch. I'll be fascinated to see how that evolves, because it could force change in that asset class being about an alpha play to a cost play. So then it favours the big players again, which I'm not sure what that does to the industry. But anyway, watch this space. Forgive that. But so that's interesting. But the flip side of that is I'm looking for alternatives that the average return on private equity at the index level, we're into single digits. Of course, there are some managers that are way beyond that, and probably some that are way below. But the average, the index is single digit, and that could last for a couple of years. So I'm looking for alternatives. Now, the key, I think we've mentioned this, is regional alpha. I can find things in other parts of the world, in public markets, that will deliver me a positive carry, that will compound over time, that are liquid, and they're called dividends. Now, you're not going to be like the real popular guy at the party, but you could get rich. You might
be able to pay for the party.
Well, yeah, in retrospect at least. I'll take credit. But you think about it. There's loads of 5% dividend stocks that grow their dividend higher than a rate of inflation, that also buy back their stocks, which enables you to compound and reverse. So in a couple of years' time, you're matching what you'd get from your private equity portfolio. And year 7, it's doubled, it's double digit. By year 10, you've got a really good return, assuming no leverage and no price appreciation. The current bid in some of in the FTSE, for example, of private equity buying these public assets is 50% premium. So I think that's a good risk-adjusted, quite safe, slow, boring way. And boring's good. I don't mind. Let's get rich slow. Which for allocators who are presumably taking a long-term view, they're happy enough to invest and lock their money up for 10 years in private equity. I think that's an area where they should be thinking more about.
So, Gary, we've covered a lot of ground. Talked about, talked about the Olympics a little bit. Talked about some regional things that are going on, some asset class stuff. Is there anything that we haven't covered that you think might be interesting? We haven't covered AI in a meaningful way. I mean, how can we have a conversation and not talk about AI?
So, artificial intelligence is the antidote to natural stupidity.
Well, then there's hope for me. Excellent.
And that's why I use it so much. Look, so right, I guess there's a couple of questions here. Where are we in the cycle? Do we keep buying AI stocks? I kind of feel I don't think it's over, but I think we may have run a bit too fast, too quick. And I think, we've partied pretty hard, and I think there's a period of sobriety about to emerge.
For people who have lived through the dot-com bubble, we may have seen this before. Is that a...
Yeah, I don't think this is a bubble, insofar that, if you look at valuations, they're above fair value for sure. I don't think anyone would contest that, but, I've seen them far higher above any estimate of what fair value is. But I think the narrative needs to change. A couple of reasons for that. I mean, at the moment, it's all been about CapEx. I mean, the amount of CapEx spend from the Mag 7, it's extraordinary. I mean, what the Mag 7 are spending on CapEx as a percentage of the S&P 500 is, it's about a fifth. It's eye-watering. It's enormous. But of course, we need to ensure that those investments deliver a return. Starting to see some question marks around the consumer applications and the return profiles of them. We're starting to see, as you always do, more competition into that space. Those that provide the picks and shovels to that infrastructure spend obviously have still done quite well, but we're starting to see a few more entrants like Cerebras, who have just announced their IPO. Apparently they're a credible threat to NVIDIA. That's a headline. I've got nothing to back that, but they might chip away at their dominance. Forgive me. Bad.
Well played.
So that's signals. Signals are always interesting in terms of where we are on the hype cycle. A couple of things happened recently, and it's for you to decide whether they are positive or negative signals. We had the first I'd seen a company change their name to add AI, a company called Tempus. It's now Tempus AI. It IPO'd recently. It's actually done quite well, but that might give people some muscle memory of what happened back in 2000. We saw a number of, I think Viacom from memory may have changed or tried to change its name to .com, and so that's one of those signals for you to decide whether it's positive or negative. And I think the share price will tell you. We've had the outlandish valuation call on NVIDIA. Unfortunately, it comes from someone I really respect and think is very, very good. And if you read his rationale, it's incredibly thoughtful. And that's James Anderson, that used to run from Bailey Gifford, and early investor in Tesla and all these sorts of things. And he has made, obviously there are some assumptions, and these assumptions would have to hold true. But if you do, he's got a valuation of $50 trillion, which is more than the S&P. So that's been caught by people, the headline. But of course, as always, if you read what's behind it, it's very rare. And he gives a low probability of that outcome, but the headline doesn't know that. And we're starting to see some questions around use cases not delivering on the hope. Microsoft had a few clients drop their Copilot recently. I think Meta dropped their celebrity AI chatbot, having Tom Brady, talk to you on chatbot for your quick. That's pretty cool. But they've canned that. And the what's the think tank that's come out and done the survey and showed that most people who have been given targets by way of productivity, about 70%. What's the name? I'll have to come back up in the show notes of the think tank. About 70% of people surveyed have no clue how they're going to be able to use AI to get to those productivity. So there's a bit of questions starting to be asked. I think we need to see new applications emerge, which they will. But until we get to that point, I think some sobriety and some consolidation is probably quite warranted.
Yep. Yeah, certainly we're trying to move from that hype cycle to tangible benefits is really what we're going to have to see.
It's all about. And I just think about it from my own perspective as well. I mean, whenever I'm asked about, the industry, in our industry, I often say, look, the first challenge we face is the data. We've got to get the data in the right shape, form, and place before we can apply a clever LLM to it. So that's the first challenge. I don't think we're there at the industry level. I don't think we're there yet, but I think we're a lot closer than what we were 5 years ago. So that's the first challenge. The second challenge is we're in a really regulated industry. And if there's ever a steward's inquiry and they ask you to show your working, it's very hard to do. You can't.
The answer comes out of a black box.
And the way those neural networks are structured. So until we solve for that hallucination point, I think that is a challenge for our industry where we can't tolerate error. And then the final thing is to assume there is insights from your data, you must first assume your data is insightful. I had someone call me recently and say, Gary, we could take all the stuff you've written on the weekend and we could, put an LLM on it. What are you going to find in that? There's nothing insightful. So anyway, that's me on AI.
There you go. Well, I think that sounds like a great way to wrap up our conversation. But Gary, really appreciate you taking the time.
Pleasure.
Always great to have you on. Looking forward to seeing how some of these themes start to play out over the coming months until we can have you back. But as always, a big thank you to our listeners. Really appreciate everybody's time and attention. And thank you for joining us on Market Pulse by Faster Forward. Look forward to seeing you on our next episode.